All right, let's just jump right into this. Welcome to today's Explainer, where we're putting onsemi, a massive player in the semiconductor space, through the ultimate test. You know, as an investment analyst, I absolutely love breaking down a stock by looking at it through the eyes of the masters. So today, we're going to run onsemi to a rigorous gauntlet of legendary investment frameworks to answer one simple but absolutely crucial question. At its current price, is this stock a buy, a hold, or a sell? Here's our roadmap for the day. We'll start with the contender snapshot, move through the Buffett lens, the Lynch lens, and the Graham lens, look at modern valuations, and wrap it all up with our final verdict. So, let's kick things off with Section 1, the contender snapshot.
Meet our contender, onsemi, trading on the NASDAQ under the ticker symbol ON. Just to give you a quick lay of the land, onsemi is a heavy-hitting semiconductor manufacturer with a $32.3 billion market cap. In just the first quarter of 2026, they pulled in over $1.51 billion in revenue. They're a total powerhouse in intelligent power and sensing tech. Honestly, if you drive an EV, if you operate factory robotics, or if you tap into massive AI data centers, there is a very high chance onsemi's silicon carbide and power chips are the literal brains making that tech run safely.
Now, breaking down where that money actually comes from, automotive is their bedrock. That segment brought in $787 million, followed by industrial at $426 million. But, the true star of the show right now is their AI data center revenue. It sits over in that remaining $300 million slice, but management noted that it actually doubled year over year. I mean, as power demands for AI just explode, onsemi is positioning itself as a totally critical supplier.
And that brings us to the price tag. As of July 31st, 2026, onsemi is trading at $83.12 a share. It's definitely riding that wave of AI optimism, but we can't ignore that it's also facing a pretty cyclical semiconductor manufacturing environment. So is $83 a bargain, or is it a value trap? Let's bring in our first guru to find out.
Moving right along to Section 2, the Warren Buffett lens.
So, what would the Oracle of Omaha think? Well, Warren Buffett looks for a few specific things: a durable economic moat, honest management, consistent earnings, and manageable debt. Qualitatively speaking, Buffett would find a lot to love here. onsemi has this incredibly solid economic moat driven by high switching costs. Think about it. Once an automaker builds onsemi's elite SiC technology into a 900-volt EV platform, they almost never switch suppliers. The redesign costs and safety risks are just too high. Plus, CEO Hassaneh El-Khoury has shown really disciplined execution, heavily investing in high-growth AI and EV markets even when demand has been choppy.
But here's the sticking point. Buffett loves a high return on equity, and onsemi's current ROE sits at just 7.67%. So why so low? Well, they recently posted a GAAP net loss of $33.4 million in Q1 that was heavily dragged down by $329 million in restructuring and impairment costs as they literally realigned their whole global manufacturing footprint. Since Buffett prefers super consistent, clean earnings, this messy transitional phase would definitely give him pause. On the flip side, let's talk cash, because Buffett would absolutely approve of this balance sheet. They are rocking a very conservative 0.41 debt-to-equity ratio. And if we want to calculate Buffett's famous owner earnings, we can look at their trailing free cash flow, which is a massive $1.2 billion. At a $32.3 billion market cap, that translates to a free cash flow yield of about 3.66%. For Buffett, that yield is probably just a little bit too thin. He'd likely call this a great business, but he'd want a wider margin of safety on the price before jumping in.
All right, Section 3, the Peter Lynch lens.
Peter Lynch is famous for hunting down growth at a reasonable price, and he loved to categorize companies into different story types. Right now, onsemi is this fascinating hybrid. On one hand, it's a cyclical turnaround recovering from an industry slump, but on the other hand, its AI and EV segments are textbook fast growers. Lynch loved it when a company had a hidden, fast-growing engine tucked away inside a more traditional business.
And here's a number that would make Lynch sit up and pay attention. onsemi's PEG ratio is 0.79. Now, the PEG ratio is just the price-to-earnings ratio divided by the growth rate. And for Lynch, finding anything under 1.0 is basically the holy grail. It means the market is heavily discounting the stock's future growth. Given that their AI data center business is expected to double in 2026, the growth story here is totally undeniable.
But, and it's a pretty big but, here is a massive red flag for Lynch. Over the last 6 months, there have been 12 insider sales totaling over $17 million and absolutely zero insider buys. Even the top brass, the CEO and CFO, have been trimming their positions. While institutional ownership is holding steady, Lynch had a famous saying, "Insiders might sell for a dozen reasons, but they only buy for one. They think the price is going to go up." This total lack of buying would make Lynch label this a cautious buy at absolute best.
Next up, Section 4, the Benjamin Graham lens.
Benjamin Graham is the grandfather of value investing. He's basically the ultimate conservative bouncer at the investing nightclub. Let's see if onsemi can even get past his defensive checklist. Adequate size? Check. Pass. Moderate debt? With a massive current ratio of 4.87? Pass easily. Earnings stability? That's a fail thanks to that recent Q1 restructuring loss. Finally, a moderate price-to-book ratio? Graham wanted this strictly under 1.5, and onsemi sits way up at 4.49. For a strict Graham value investor, this stock just completely fails the checklist.
Let's crunch the numbers on Graham's famous intrinsic value formula, taking the square root of 22.5 times earnings per share times book value per share. Using their forward P/E and P/B ratios to grab our estimates, which gives us roughly $3.36 for EPS and $18.51 for book value, the math spits out an intrinsic value of exactly $37.40. At the current price of $83, Graham would see absolutely zero margin of safety. To him, this is a glaring sell.
Let's pivot to Section 5, Modern Valuations.
So the old school legends are a bit skeptical. Let's see what modern, cold hard quantitative models have to say. For our discounted cash flow or DCF model, we're projecting out their free cash flows based on that current $1.2 billion trailing figure. We're going to assume a 3% perpetual terminal growth rate, which I think is super fair for a company entrenched in the massive trends of electrification and AI. And we'll use a 10% discount rate to account for the cyclical risks in the semiconductor space.
When we run that sensitivity analysis, locking in our 10% required return and 3% growth rate, the DCF model gives us a base case fair value of exactly $85 per share. Considering the stock is trading right around $83 today, the math suggests onsemi is perfectly, almost eerily fairly valued by the market right now. There's no massive premium, but no huge discount either.
Things get really interesting when we stack them up against a heavyweight competitor like Texas Instruments. On the surface, onsemi looks way cheaper, rocking a forward PE of 23 compared to TXN's 31. But TXN commands that premium for a very good reason. Their gross margins are an insane 61.4%, blowing onsemi's 38.5% right out of the water. Investors are literally paying up for TXN's higher quality and overall earnings stability.
Finally, Section 6, our synthesis and final recommendation.
We've run the gauntlet, and honestly, the signals we're getting are incredibly mixed. Graham hates the price and screams sell. Peter Lynch loves the growth and the PEG ratio, but hates the insider selling. Our DCF model says it's practically fairly valued at $85, making it a classic hold. And against its peers, it looks like a pretty decent buy, even if the margins are lagging a bit behind the industry leaders.
So, blending all of this together, my final verdict for onsemi right now is a definitive hold. The upside is absolutely real. Their AI data center revenue is exploding, and they own the EV silicon carbide space. But you can't ignore the downside: heavy restructuring costs and margins that just trail top-tier peers. If you're sitting in cash, the models say wait for a pullback. Below 70, that's when the margin of safety opens up, and both Buffett and Lynch would likely view that as a highly attractive entry point. I'm going to leave you with this to chew on. When you're looking at a company right in the middle of a massive technological shift, do you align more with Peter Lynch, hunting for future growth and great PEG ratios, or do you stick to Benjamin Graham's strict, uncompromising rules on intrinsic value? Which lens do you trust most for your own portfolio? Think about it. Thanks for hanging out with me for this explainer, and I'll see you next time.